We'll help you open up your eyes on what the options are. We'll guide you. But at the end of the day, the choice is yours. And you either choose to tackle the problem heads on, regardless of how simple or how complicated the path may be, and choose to think about opportunities. Because sometimes, there may be a problem here, but you can fix it by identifying an opportunity and not necessarily just like looking through this lens here.
All right, Dalia, how are you today? It's been, what is this, like episode 3 that we've done, 3 or 4, and it's been far too long since we've had a conversation. How the heck are you doing?
I am fantastic, Russell. How are you?
Oh, I couldn't be better now that we're talking. I hope we can be like a little lighthouse in the storm, if you will, and point ourselves towards the shore, and hopefully there's no rocks in the way on the path. I think the last time we talked, I think it was in the summer, and it was just when the rates were starting to go up, and your conversation was, and things are going like crazy.
Yes. I'm feeling great today because I had my full tequila bottle right before the show.
Well, that's good. We had a little bottle. Did it have the one with the worm on the bottom, and we have to, finish the bottle?
Yeah, that's right.
Yeah. So first and foremost, how are you doing? How are you? How's Victor? How's everybody doing?
We're good. We're very good, and I choose to be good. Let me put it this way, because the market we're in is not an easy market. There is a lot of negativity and noise and pressure, and of course, we deal with we see financials day in and day out, and there is pressure out there. So I always say, it's a choice. How we feel is a choice, and I could just go, oh my God, it's overwhelming right now, and the sky is falling, and it's painful. But it's just an interruption that's going to go away, and we have to still enjoy our life and still, get up and be our best and do our best. And that's why when you ask me how you're doing, for real, I feel excellent.
Good. It's a choice, and I love that attitude. There's never a shortage of things that are wrong. Never a shortage. But it's what you actually choose on it. And it was funny. I was just having a recent conversation with a fellow who had one of the most traumatic things that you possibly could have. He was a first responder and with the city police, and he responded to just a routine call. And he within a half an hour, he found out that he had his finger on somebody's carotid artery in their neck, and he was the difference between that person living and dying for like about 45 minutes. And the trauma that he went through, and I was just like, oh my goodness, like
oh my goodness.
Between that and then a good friend of mine from elementary school and high school, he just posted something yesterday on Facebook, and he goes, yeah, with great sadness, I'm sad that my brother and my son and my brother's daughter, passed away. They fell through ice, and the father and his son and his brother went to try to save this child that fell through ice, and they all drowned. Like, it was just like,
oh my gosh,
crazy.
Oh my gosh. That is unreal.
Yeah.
That's unreal.
No, I don't mean to put a wet blanket on our conversation here today, but you choose how to make the situation. And in some cases, there's some incredible things that are opportunities. And in some cases, there are some really challenging times that you have to overcome. Okay?
Yes, absolutely.
Now, first of all, Dalia, how did you fare after your cash flow recharge event? This was your first toe in the water of putting on a live event, and it was completely probably a lot different than a departure from doing mortgages and helping people with financial planning. How did you find the process, and are you up for another one?
Well, I have to say I was on a high, throughout this event, just listening to the speakers and learning things myself and getting feedback from clients. It was fantastic, but I underestimated what it takes to actually put together an event. And I learned a lot through the process, between technology blowing up and we have to pretend that everything was fine, on camera. So I underestimated, but it turned out to be a fantastic event. Everyone learned a lot, and I would actually do it again.
Nice, good.
And Russell, your content and your advice and your presentation was like right up there, and we're very grateful for what you've shared during that event.
I'm honored that you invited me, and I will do whatever I can to help inspire people. And for the majority of people that are listeners on my podcast, number one is, Dalia and I have done some long form episodes, but you also will have heard Dalia's voice on literally every episode, right in kind of the mid roll. There is, I actually look forward to your mortgage tips and your financing tips. I actually learn from that before I send it off to the editing team. I say, I want to listen to this because I want to learn too. So it's one of my favorite segments that you do. You contribute on an ongoing basis. And I just want to thank you. And our listeners want to thank you as well.
My pleasure.
Yeah, you're one of the best at doing that. Like, I wish everybody would take a page out of Dalia's book of you step up, you speak on everybody's stages. When you get invited to do something, you're on a podcast, you deliver investing tips and share the information. And it's not all about the transaction for you, is it?
No, it's never about the transaction. I always, this is how I operate, and my team operates the same way. We always believe in adding value, regardless of whether or not there is a transaction. Yep. Sometimes clients call us, and we know by just the first call that it may not be the right time to do something, or we can't help them for whatever reason, right? And we still choose to add value, whether that's through giving a piece of advice that will help them, or connecting them with someone that will help them, or helping them see something that they didn't see. So, and that always really served our clients and served us well as well.
Yep, I 100% agree. Now, if somebody hasn't checked out the other episodes that we've been on, and I was I'm going to date myself with this reference of the Coles notes. Are you familiar with the Coles notes? So
no.
Crib notes, remember that? When you got a book report in high school, and then you had to write the book report, and then you didn't have time to read the book, but you went and bought the little cheat notes on it.
Okay, yes. Okay, I know what you're talking about. Yeah.
On the prairies, we used to have a place called the Coles bookstore, and there was called the Coles notes. So if I was to ask you what the Coles notes of who you are and what you do, how would you answer that question?
Is that
the summary of everything that you're involved with and how you help people?
The summary really is that we are passionate about helping clients build wealth through real estate the right way, and bringing the right money sources together to help them create the portfolio of their dreams, whether it's residential or multifamily or combination of. I've seen clients, as they build wealth and abundance, create time freedom and create cash flow and create life experiences, not just for themselves, but for their families, and contribute better.
Yep.
And I just love that outcome or the fruits of the process. So that's why we do what we do.
Nice. And would you say where would you say the bulk of your clientele is location wise across Canada?
The bulk of our clients are in Ontario,
okay.
But we also have clients in Alberta, British Columbia, Nova Scotia, Saskatchewan, yep. And Manitoba. Right. And I forgot one, but we operate in 5 other provinces outside of Ontario, but the bulk are in Ontario.
Right. So suffice it to say, you have your finger on the pulse of a fairly national basis of what's going on, and yeah. We both would agree that real estate is local, even to a point where it's hyper local in many respects. Yes. But we're going to try to do our best to kind of shed some light on what's kind of going on in the marketplace out there. So, from a mortgage perspective, what's going on in the marketplace, and how can you provide some top line information for people on just kind of the state of the nation? If you were to stand in front of a group of investors, what would you say it's going on in the marketplace right now from a mortgage perspective?
So the point we're at right now is an interesting point, because we are at the peak of the pressure when it comes to rates, but we are starting to see optimism in the prospects of the Bank of Canada cutting rates. Because if the last gesture was for the first time indicative of a rate cut. Does it mean that it's going to happen soon? Unlikely, but at least we know now that it is on the horizon. So that's an interesting point to be at. There is a lot of pressure that we're seeing in the market, especially for those who are on variable rates or have come up out of a renewal into a new rate environment, into much higher payments. So there is that pressure, but there is that optimism now that there is a rate cut on the horizon, likely sometime in 2024. I mean, not the beginning, but later in the year, but that timeline may shift. This is as of today. So it's an interesting, point to be at. So that's the residential state of the nation. We are also seeing a shift in how investors are using money. There is, as we're talking right before this session, Russell, the MLI Select program, the CMHC money on commercial properties, whether you're building or whether you're converting residential to commercial, or whether you're renovating, repositioning an asset, that's cheaper money in the bigger scheme of things. You're still talking about crazy lower rates relative to where residential rates are, and higher loan to value, significantly higher loan to value. So we're seeing more investors also now play in that sandbox, and it's increasing.
Yeah.
And what we're also seeing is higher demand for private money overall, because things are not happening the way they used to happen in the residential space. Qualification is tougher, rates are higher, rules are, so, and people still need to do things. We're not going to all sit here and just, wait for life to change, right? We have to take control and keep doing things. So we're seeing more demand for private money. And in fact, what's interesting is the private money pricing right now is close to what's called B lenders pricing. So there is the A lenders, the banks, there are the B lenders, which are the alternative lenders, and then there is private money. The rates here are similar. The fees are higher, but the rates are similar, and they're interest only versus principal and interest. So private money is at its highest appetite right now, and this commercial money too is also investors are tapping more and more into it. So that, in a nutshell, the highlight of the landscape.
Yeah. No, I would say, and I'm not trying to be over hypey or hyperbole with the next comment I'm about to say, but I would think now more than ever, of any time in that I've been an investor for 23 years, is you need an expert on your team navigating the mortgaging waters right now. Like if you're trying to just figure this out and go on your own and go to a branch person and stuff like that, now it's almost suicide, to be honest. So what I'm trying to really get to is you need the professional advice and the guidance from a team of people that are living and breathing it every single day, and they're seeing the path through the rocks to try to get you to your destination more than ever. Now, I know you agree with that, obviously, but I'm just saying that from another perspective. I'm not a mortgage agent. I don't have a dog in this hunt, but I'm saying now more than ever, you need a professional.
Yeah, absolutely. And I know it sounds self-serving that the mortgage broker is saying, come and talk to a mortgage broker. But the truth is, that's the truth. The truth is, I worked for the banks. I worked for the banks for 15 years. And before I switched to the broker channel. And at the end of the day, the bank is one entity, and they have their own products on the shelf. They have their own way of looking at deals. Not every lender is the same. Not every lender does the same, offers the same products or thinks about deals the same way. As a broker, we're on the other side. We don't have one shelf. We have multiple products, and we know how everybody thinks. So that's really the key point here. Yeah.
And in some cases, some quote unquote pots of money are more friendly than others. And then that's a constant evolution where at one time one is very friendly and then one is very stringent. And then the pendulum swings back again. And then another one's friendly, another one's stringent. And it's just knowing the chess pieces and knowing the strategy more than ever is very important.
Yeah. We're like the Walmart.
Yeah, well, I would imagine you, as somebody who sees this, you would probably agree that the people that are weathering the storm a little bit better were people that probably went through your process very early and got a plan in place up front, and now they're weathering it a little bit as opposed to winging it, if you will.
Yes, I can proudly say that despite the fact that everyone is feeling the pressure, we haven't had investors who lost their shirt or couldn't exit deals or got stuck with money, because there are investors who got stuck with private money and could not exit, and there are investors who lost properties in this process, and there are investors who are forced to sell. So yeah, we are big on risk management and proactive planning and strategy rather than just transaction. So that definitely helped.
Yeah. Okay. So, you're obviously familiar with the name Benjamin Tall. Benjamin Tall from CIBC.
Yeah.
I like Benjamin. He's a from an economist. He's actually he's got a personality. He understands it. He gets it. He's not just an academic. He understands real life all at the same time. He was saying recently, and hopefully this is maybe true or not, but I would like to get your perception on this as well, that there's an entire giant mortgage renewal wall that's coming, where people in 2019, 2020 that renewed in 3% or less that are now going to have to be renewing in 5% or more type of thing.
Yeah.
Is that of a concern within the industry, and is that one of the reasons why maybe people think it's going to come down in the next little while? What's your take on that?
Well, definitely there is a wave of renewals coming up, and the Bank of Canada is aware of that, and I think that also played a role to a certain extent in their decision to just pause or hold versus continuing to push harder. And thankfully, the indicators are helping the situation, of course, because they're going by these indicators. But is there a concern overall about increased defaults because of this wave? Well, here is the thing. I was just going through a report with published by CMHC, and you would expect that by now, we're seeing an increase in defaults. We're, seeing for sale signs come up, like a domino. But in fact, the default rates are not increasing. The default rates have not increased according to CMHC. So I don't think there is an overarching, like, really big concern about defaults because of this new wave of renewals. But definitely, I think the Bank of Canada took that into account when they've made the decision to hold.
Right. Now, we can sit here, and there's obviously people, which I would say is a lot higher pay. The old saying is higher pay grade than I am. They're probably a lot smarter than I am, but who knows? A lot of people are sitting there and that are just making decisions that are really trying to almost intentionally thwart and slow down the market, and not turn it into a ditch, but they're trying to navigate the market to a slow down pace, if you will, which is a little dangerous in my opinion, right? And it probably came because the interest rate was too low for too long, and now they're trying to go too high for too long, and maybe hopefully in the middle it'll make sense. So the question I'm going to get to eventually here is, do you see some cracks and risks that are happening out in the marketplace of any defaults? I know you answered that a little bit before, but are you seeing some cracks in the pre-construction market, in some development projects that are being delayed? Are you seeing some things that may not just be a soft landing, it might be actually a hard landing?
There is. I'm concerned about definitely a couple of things. One, private money. There is a much bigger appetite for private money right now, given the circumstances. And I am not sure everyone who's taking private money has a true exit strategy out of that loan. And that's always been something I've talked about. When people take private money, they have to truly validate with their broker upfront. How will they exit that money? Not leave it to chance, not leave it to, I'm going to sell or a refinance. And I'm seeing a wave of money shift to the private space. I just don't know how the risk is being managed to make sure that everybody is going to come back to the safe harbor. So there is a little bit of personal concern there on that front. With our clients, we make sure there is an exit strategy. And if there is no exit, I don't recommend taking private money. We're seeing some new construction projects come our way where here is a story, and that I saw samples of it. I haven't seen the entire story, but I assume there is more of that happening. Here is a story. When clients bought new constructions years ago, they don't have a firm approval. They can get pre-approved. Some banks like RBC offer a firm approval, which, if they can go to RBC, and as a broker, I don't deal with RBC, but I'll tell clients, if you have a new construction and you qualify with RBC, go to RBC, get that firm approval done so you can sleep at night, so that when the time comes for you to close the deal, you don't have to worry. It's a big feature in my view, but a lot of lenders don't do that. So what happened is clients bought 2-3 years ago. It's time to close. Back then they qualified. Now they don't qualify with an A lender. They don't qualify with a B lender. They now have to take a private loan. Their cost has become this big, which they didn't plan for. Now it's one thing to close the transaction. It's another thing to carry the property. So that's problem number one. I'm seeing clients in that situation. Problem number two is values. In some cases, values have shifted. The general theory is you buy new construction, and by the time the deal closes, that property is going to be at a higher value and everyone is happy. And that was the story when the wave was high. But in some cases, that's not the case. The value is actually lower depending on when that client purchased. So how do you cover these shortfalls? Right?
Yeah, I had a conversation with a couple, I'd call them small and mid-tier, and they would use the same terms as well, small and mid-tier developers out in Ontario. So here's the conundrum is there's such a shortage of housing. Like there's such a need for some densification. There's such a need for houses. I think CMHC is forecasting 3.5 to 4 million houses short in the next period of time. Like it's ridiculous how many houses we need. Okay. But at the same time, some people that are trying to add density and add houses, they sat there and they have some land positions and they were looking to build on them. And then all of a sudden, the values have started to drop. So they're unable to sell them for the value they need. And then so what they've done is they've scaled back. They've stopped their projects. They're literally just sitting on bare land because it just doesn't make sense for them to move forward. But then all of a sudden now, their holding costs just keep ratcheting up. And they're now at a point where they've had to let go a lot of their construction managers and let go a lot of their people. And they're in a point that it just, we're playing the game right. We're trying to solve a problem. We're trying to solve the need. But the winds and the headwinds are just so strong at the moment that we have to just kind of hunker down and wait it out for a few years.
Yes. Yeah. On the small developers, small, medium. Absolutely. Yeah. I've seen that as well.
Yeah. And, but then like I said, on the flip side, there's such a need for some housing. Like the rental market is just on fire. A lot of the places and some markets they just need, there's like a forecast. We're adding 600,000 people a year to the country, and we don't have a plan for them, right? However, we have a government program to spend $40 billion to do car batteries in Windsor, but we don't have a $40 billion housing program to help support some people to build some houses.
maybe the car batteries will help the housing.
Well, I think they will. Right? Yeah, it's those
Right?
those Volkswagen batteries that we're going to need. That all those EVs are going to solve our housing problem, won't it?
Exactly. Exactly.
So maybe the government should just listen to my podcast, and then they'll go, oh well, we'll just solve all the problems now, right? And then on top of that, the developer is telling me that all the development fees and all the costs and everything, especially in Toronto, have just gone through the roof. Like it costs more money now to build a house than it did a couple of years ago, and that doesn't even count your holding costs and your interest costs and your financing costs. And
Yes.
the developer is the one taking all the risk and holding the entire bag for helping to solve the housing problem.
Yeah.
Now, don't get me wrong. I'm not trying to play a fiddle and have everybody feel all sorry for the housing developers, but I don't understand why it's not that we don't want to help developers and help people building houses to make some money. Like if they don't make profit, they don't make margin, they won't do it. And if the private developers aren't going to do it, the government ain't doing it. So I honestly don't know what the solution is in many respects. What's your thoughts on this?
I actually don't know what the solution is. I mean, for me, it's you want to create housing, create the incentives for the people who are building houses, but that's not how it's lining up, and I just don't know where the issue is.
Yeah, and I know each market is completely different and things like that. Like I know the market that we operate in Edmonton, they're extremely proactive on what they are doing. And here's what they do is they've taken a look at their demographics and they know they're adding 1 million more people in the next 15 years, and they don't want to grow the city out any further. They want to grow it in, and they have a lot of old little houses on big giant lots, so they're approving a densification blanket across thing that you can potentially in some cases build up to 3 stories on residential properties, and you can add up to 18 units on some cases, right?
Wow.
And so they're being proactive, and not only are they being proactive, I know we had one of our applications that got submitted because we had the zoning right and everything like that. We went in with the plans, everything. Within 10 days, we had permits. 10 days.
That's crazy.
Yeah.
That is super fast.
But on the flip side, even though they can add inventory, sometimes if you add supply too fast, that's a bad thing too. So it's a little bit of a balancing game, right?
Mm-hmm. There is Bill 23 here, which allows densification, but not to the same extent here.
Yeah, I know they've announced and they've talked, but is it actually implementable? Like are people able to? Does it actually make sense for somebody to take a single family house and do all the work and go through it and add 8 units to it? And does it actually make sense?
Actually, it does make sense if the investor is using the cheaper money, like construction money with CMHC, commercial money. It makes sense. I've seen it happen with many of our clients, and I'm personally starting to utilize that type of strategy as well. So the lift in value has to be there. Obviously, the NOI has to support a bigger loan amount on exit so you can pay off for your construction cost. But yeah, the Bill 23 makes the process easier.
Yeah, I 100% agree. Now we have a different out west. We have a different terminology with a lot of these things and stuff like that. But we just need to get some grease in the system and get the machine working, if you will, right? And we need to get. And then if you couple that with somebody was telling me that there's a huge trades shortage out there too. It's like so people, we need to build houses. There's a supply shortage. And then there's a trade shortage, and then the development costs and fees just don't make sense to really do it. So it's one of those things. It's almost a game of chicken. Like something has to give. Like somebody has to blink first, right?
Yes, I hear you.
Okay, so you mentioned something earlier. So your business is pivoting a little bit more into private money, a little bit more from traditional on the residential conventional side. Is that? Did I hear that correctly?
We're not pivoting. We are growing.
Growing. Okay, you're growing. Okay, you maybe didn't focus on it.
Yeah. So I've always believed that private money is a stepping stone, and it's still a stepping stone. It's not long-term money. But I've always looked at every option for clients, left stones unturned before I jumped into private money, unless there was a very strong reason to why we use private money. That's been always my philosophy. But now there are clients who need private money because they can't get enough on this side. I give you an example. Have AAA clients switching from a B lender, principal and interest payment, to a private interest only payment, so they can get breathing room in their budget. And then we're going to write the cycle for 12 months, knowing that we can take them back to a B lender. So here's an example of a new use for private money that did not actually exist before.
Yeah.
So we're growing that practice. We're offering better products. We are managing risk, given this new environment we're in, from different perspectives. But we're still doing a lot of residential, and we're doing multifamily.
Right. Okay. So maybe a good pivot is to talk a little bit about multifamily, because that is one of the very viable things that is really working out there very, very well at the moment. Or do you do a lot of commercial and multifamily financing from your company?
Yes, multifamily and mixed use, whether it's a turnkey, a reposition, or a construction.
Nice. And I imagine it's probably growing that way because it's one of the things that is still makes sense.
Yes.
Yeah.
Yes.
And it's funny, like a year ago when we were doing our suited houses, a house with a basement suite and things like that. And maybe it was a little more than a year and a half ago, we were getting, between $400 and $700 cash flow on it. Now, on to take a traditional conventional mortgage even at the best rates, that $400 to $700 is negative $400 to $700 at best, right? So somebody's sitting there goes, well, I don't know if I have an appetite to have to write a check for $800 a month every month and just keep doing that. Oh, by the way, I'm going to make up for it, but I'll have 5 of them, right?
Yes.
So that's one of the things that I'm helping people with is I'm helping people do a repositioning strategy. People that maybe bought a house that isn't cash flowing, but they have some equity in it, and there is a value to potentially sell it to a homeowner, take the same capital that maybe where it was 2 and then turn it into a buy of a 6 or an 8 or a multifamily property. The interesting thing, the way the math works out, because of the MLI Select program, you're getting into with the exact same capital, and you're almost doubling your density of units you have. I just worked out a plan with a client where he had 4 properties, 2 suited houses that were negative cash flow. They were positive, they're now negative. And by taking the exact same capital, moving it in, we could potentially get them up to 12 units, 2 sixplexes. And with the CMHC financing, the cash flow now goes from negative, say, $1,500 to positive $2,000. There was a $3,500 swing in cash flow just by repositioning it.
Yeah, it's crazy. The extended amortization to up to 50 years is huge, right?
Yeah, and if we didn't have that it wouldn't make sense. It wouldn't make sense. Like, don't get me wrong. It's a combination of a whole bunch of things, of the extended amortization, the discounted interest rate, the high loan to values. It's a combination of multiple things.
Yes. Yeah.
So if somebody's sitting here and they're listening to this, commercial financing, and we've used this term, the MLI Select program. What is that, and where can a person get a little research on it? And does your team do a lot of these mortgages?
Yeah, we do both. Conventional is what it's called, CMHC, and MLI, and we have a direct relationship with CMHC. It's called a direct correspondence. So that's when a broker has direct access to CMHC, where they have control over the conversation. And can then get what's called the CMHC certificate at hand. And we can then go have the lenders bid on, how they want to price the deal. Essentially, what it does for you as a client is it helps us accelerate the process. And also, yes, CMHC is CMHC, but when you have middle person talking to another person, it slows things down. So that direct communication helps, but also lenders like to see the CMHC certificate. They will compete for that business. So it allows us to get you better pricing. So yes, Russell, we do, we fund MLI deals and conventional deals. And what the program is, MLI program is really is a scoring system. So what they're doing is they're trying to help the housing situation by providing incentives to those who are building units, or those who are repositioning units, or even buying turnkey, as long as they are tackling certain things that matter from a CMHC standpoint. So they have points if you make a percentage of the units accessible, and they have clear definition on what that really means. They have points if you are building something or renovating and enhancing the energy efficiency in the process. So you have to bring in an energy engineer to basically help you spend on the things that will, improve energy consumption. And for that, you score points depending on what these improvements look like. It could be, level 1 points, or level 2, or level 3. And if you score at level 3, you get the best benefits out of the program. And then the third bucket for scoring is what they call affordability. So they want to keep a percentage of the units affordable. And they publish a sheet that says the median renter's income in this area is this. As long as you keep X number of units below 30% of that number, we're going to give you points. So it's a scoring system. And if you aim to score 100 points, and you could play in any of these or a combination of, and for that, you get highest loan to values. They can go up to 95%. Extended amortizations, they can go up to 50 years. And what's called the debt coverage. Yeah. So if you take the same building and try to qualify it for a loan under the CMHC regular program versus scoring on these points and getting it done under MLI, you will get a bigger loan amount under the MLI program compared to the other program. Yeah. And that's really one of the key features as well.
And then they relax the debt coverage ratio as well to a 1.1 as opposed to, is it usually 1.25, give or take?
1.25, 1.3, depending on the number of units.
Yeah. Now, speaking of number of units, and it's funny, as I was, I'm gonna confess that I, old dog, learn new trick here. And I think I made the joke on your conference that I don't know why I waited so long to get into commercial financing. Like I waited 20 plus years before I applied for my commercial financing. And it was because I was scared. It was like the loan amounts were bigger. Everything seemed more difficult. But as you go through the process, it's actually like a little bit of a breath of fresh air. Like they treat it based upon a business case. They treat it based upon, the quality of the property and the incomes it generates. There's no perceived wall of you can only get 3 mortgages. Like if everything's cash flowing and you're doing well and net worth is good and you got strong borrowing people with you, they're very welcome and opening. And they're actually more friendly when you have a $17 million mortgage as opposed to a $1.7 million mortgage.
Absolutely.
So here's what I was trying to get to is, so for you, how many units does it have to have first and foremost, just to even get the threshold of qualification?
5.
5 units or more. Okay.
5 legal units or more.
5 legal units or more. Okay, excellent. The other thing, I was sitting there going, well, CMHC, well, it's the government. CMHC is giving us the money, right? It's the government's money. But I actually learned very quickly as, no, the government is just insuring the money, and the lenders would have an insurance policy that it'll get paid back. If it doesn't get paid back, the government then pays the money. But the government doesn't have any money, do they?
Yeah, yeah, exactly. That's how it's set.
See how simple I am. I didn't even understand that at first, Dalia. How far I had to come on my learning curve to learn about this commercial thing. I go, well, the government has the money, and somebody said, no, the government don't. They just give you an insurance policy in essence.
Yes, yes, exactly. That's so.
Okay, so the point I'm trying to get to is, so if you qualify, and then the other thing, just as a key thing for a lot of people listening, if you're interested as well, as the beautiful part about, let's say you have a triplex on one, right? You have a house, a suite, and an accessory dwelling unit, and you're sitting there going, oh darn, it doesn't work, right? I only got 3 units. But maybe you have another lot beside it. So for example, a client of mine bought a property, subdivided it, and he was able to put 3 units on per lot. So now he has 6 units as opposed to just 1 3-unit. Now, instead of it being, he now qualifies under a 6-unit build.
Yes. Yes.
So that's an unknown thing that not a lot of people do know, that especially if they're adjacent properties and adjacent lots, you can take it from to not qualifying to qualifying quite nicely.
Yeah. Yeah. We do that all the time. 2 adjacent lots together, they make more than, so together they're 5 or more units.
Yep.
You can qualify them under that program.
Yeah. And I had a client in Kamloops in Kelowna. He bought a house on there and he was able to subdivide it. On the subdividing side, he was able to put a side by side. So he had 4 that he was building. And I suggested to him, I go, why don't you just keep the house on the other one, roll that into everything, and you now have 5 units. And he goes, oh, I guess I can do that. And I go, well, why not go ask somebody who can give you that answer? But that would make sense.
Yeah. Yeah. It's a beautiful strategy.
Yeah. Okay. So if somebody wanted to do something like that, maybe they had a property that they thought maybe qualified or something like that. Do you do internal underwriting? Would you be able to give somebody a financing opinion on how that would work? What's the process if somebody is sitting on something and they're going, well, you know what? I think I can probably do this. Maybe I can add some density, and because of these new laws, what would be a first step that you would encourage that person to do?
So they need to just get some preliminary idea about whether or not they can add these extra units, and just very, very high level about the costs, right? If let's say they have a 4-plex and they're going to add an extra laneway, what would that cost? Will the zoning allow it? And then what the conversation with us is, okay, let's take a look at what the future value is going to look like. Again, back of the napkin, we're not looking for Excel spreadsheets and detailed analysis, but back of the napkin, what's the future value? What future value are you expecting? What are your projections, income and expense, once you've created these 5 units, right? And let's take a look at what that financing is going to look like with CMHC, and then work that backwards to today. You've got an existing property, its value is X. You're going to need this much money to get to this future state. How are we going to help you structure that? What does the, loan to value look like? What are your costs going to look like? What's the best way to structure the deal? Given your timelines, what does this all mean? So we start to deconstruct it all to show them how to use this type of money.
Yeah. And one of the misconceptions that I've had when I'm talking to people about this as well is, and I know the MLI Select program that we're talking about is phenomenal. It is a phenomenal product and it's a phenomenal program. But remember, gang, that's the completion financing that we're talking about, of up to 95% loan to value, 50. In order to get to that state, potentially multiple different mortgages need to be put in place and multiple different financing. And typically you have to put up a lot more capital to get the property to the state to get the completion mortgage financed at the end.
Yes. So we, most of the time, Russell, on that note, we use what's called a bundle loan with a CMHC approved lender. So let's say someone has 3 units today and they're going to create 2 more units and the property is worth $900,000. Okay. We get 2 pieces of the loan, that bundle loan. One piece is to say, okay, to pay off the existing mortgage on the property, we can get you up to 75%, sometimes 85% of today's value. And we can get that second piece of the bundle loan to fund the construction of these two extra units. And that piece can go up to 100% of the total construction cost.
Yep.
And that will be an interest-only loan to get you to this exit loan with CMHC under the MLI program.
Yep.
But what we want to do is we want to make sure that whatever we're taking up here is going to be paid off for down here. And ideally, if you created value in the way, you want to get that money out. So when we do these types of loans with the CMHC approved lenders, it makes the process smoother in my view, because that lender knows that they're giving you this loan with eventually CMHC paying them out. You don't have to switch lenders in the process. You don't have to pay multiple fees in the process. And they're actually taking the risk. When clients use private money to build, right? Sometimes they get better loan to values, but CMHC wouldn't pay private money anymore. You have to actually pay that private money using a CMHC approved lender. And then you go to CMHC. So extra cost, you're taking the risk. So every client situation is different, but these bundle loans that are interest only with CMHC approved lenders are often used to get to that point to exit with MLI.
Yeah, I 100% echo what you're saying. It's a point I made earlier, is now more than ever, you need to walk into Dalia's team with the entire project plan so Dalia can maneuver the lenders so you don't paint yourself into a corner. Paint yourself in a corner a couple ways. If you have to keep switching and you keep going there and you have to go back and make a new application, honest to goodness, it's like $25,000 goes out in a heartbeat when you're talking commercial lending. That's number one. Number two is if you actually finance your land acquisition or even the construction acquisition with the wrong lender, CMHC will not cash that lender out in order to give you the MLI Select program. So then you have to go to another bridge loan in between an inter alia mortgage and another bridge loan to take money for like maybe a month or two.
Yes.
So that CMHC would be able to then cash out that approved lender list and things. And I see a lot of people getting stuck on this a little bit on what I call apartment building buyers that buy something with under rented and then they put in a renovation package into it and they use private money to do all those kind of things. And then they're going to refinance it with CMHC at the end. And CMHC say, no, we won't cash that mortgage out, by the way.
Yes. Yeah. We have clients ask us this question, and CMHC has a list of approved lenders. If you Google it, CMHC approved lenders, you'll see who's on that list. So if the lender on the current property is not on that list, you have to do this bridge loan or interim loan before going to CMHC.
Yeah. And I learned a lesson very clearly the other day on a recent transaction as well, as we bought the land with using an RSP mortgage, an RSP second mortgage, and it was with Olympia Trust, which is fantastic. But then we found out when we go to convert it to an MLI, is like, oh, well, we don't recognize Olympia Trust. However, we recognize Canada Western Trust. So So now I know if we're ever doing any RSP lending, that if we eventually know that we're going to be doing a cash out refinance with CMHC, it has to be through Canada Western Trust, not Olympia Trust.
Yeah.
So it's just these little things. And each one of these things, honest to goodness, Dalia, in this world of commercial, like, don't get me wrong, there's a lot of benefits and lots of wonderful things, but everybody's got their hand out. It's like, oh, you needed an environmental site assessment. Oh, why didn't you tell us that a while ago? Oh, by the way, it's $3,000 for this report. I go, oh, geez. And the appraisals are minimum $3,000 a pop on either, and everything is upfront in advance.
Yes, everything is upfront in advance and costs obviously a lot more than residential, but with that type of money, it's worth it. And it's important to know for those who are starting out with this, what are the costs? What's the process? So the devil is in the assumptions. And I find that some investors just make assumptions. Oh, I'm going to do this, and then I'm going to pay it off with CMHC, and I'm going to get 95% loan to value at a 50-year amortization, and I'm going to just keep rinsing and repeating. And the devil is in the assumptions. Yeah. And that's what we help clients validate the assumptions, understand the cost and what's involved so that they manage risk.
Yeah, 100% agree. But I'll tell you though, on the flip side to it, once you crack the code of the process and crack the code with the team, it truly can be a rinse and repeat strategy. It can. Like I'm glossing over a lot of details, but if you can actually get that streamlined, this is a very quick way to scale many units in a short period of time, just as an FYI.
True. Yeah, true. All I'm saying is that sometimes the clients assume certain things that may not be true, because here's a simple example, Russell. Client knows the value is going to be higher, let's say 5 million, right? Under the MLI, it does say you can get up to 95% of the value. Well, it's CMHC's value, number one, that sometimes differ, but they've been a lot better going with the appraised value. But at the end of the day, the property has to support the loan amount. So if the value is 5 and the property's net operating income can only support 3 million, doesn't matter what the value is, the loan amount is going to be 3 million. So that's an incorrect assumption right there.
Yep. Yeah, just because it says you can get that doesn't mean you will get that. It still has to pass all the checks and balances and tests and debt. And the main choke point from my seeing is really the debt coverage ratio is really where the choke point comes down to, is if you are able to get enough income for the cost of everything. And then the one wild card out of all of this, as we know, is bond rates and interest rates. You actually don't know your interest rate until about, what is it, maybe 8 weeks before it actually funds. Like you sit there go, how do I make a decision? What's the interest rate? And they go, well, here's the range. And I go, what do you mean a range? I go, and I'm sitting there going, for the first time ever, I'm now following the Canadian 5-year bond interest rate on my phone on a daily basis.
Just down, lock it in.
Like, but it's a different world, and it's a different world from a standpoint is you don't have 100% certainty of what your interest rate will be when you're doing this kind of thing. You have a range. You have, if their interest rate goes down, you actually might get more mortgage. If their interest rate goes up, you may have to actually buy down the rate, or you may have to actually put more down payment. It's a lot of. It's fun. I really enjoy the game, but it's a lot of nuance. It's a lot of details, and it's hurting my brain some days.
But like once you grasp it and you do it, it's actually easier to rinse and repeat.
Yeah, and Dalia is probably going, yeah, welcome to my world, welcome to my world, youngling.
I can't keep up with my hair coloring, Russell, for because of all of the grays associated with this process and residential, all of it.
Yeah, well, I'm looking at. I keep the same color. It's called flesh.
I want to know your tricks.
My trick is a fresh towel, and you just you get a new haircut every day. So, Dalia, what does go into kind of setting of bond rates and interest rates and stuff like that? I know that's a very complex topic, and we can go into that into another 4 more hours. But how does an interest rate on a commercial mortgage kind of get set? Like typically you get quoted bond plus 0.9 or bond plus 1.17 or stuff like that. How does that all kind of get established?
So in the commercial world, there are 2 types of money. There are the Canadian mortgage bonds, and then there is the government of Canada or internal money that the banks use. So when lenders price deals, they look at adding their quote unquote margin to these rates, depending on which avenue we're taking. CMHC money is always Canadian mortgage bonds. So there, if you go and look for the 5-year Canadian mortgage bonds pricing, there are so many sources out there. They change sometimes multiple times per day. A couple of days sometimes before closing a deal, or 8 weeks, like you said, Russell, the lender will say, okay, where are the Canadian mortgage bonds today? Okay, let's say the rate is 4 point something. And some lenders will add anywhere from 0.5 point, sometimes up to 1% to that number. And that becomes the rate you pay for as a client. If you're going for a conventional commercial loan, they're not going with the Canadian mortgage bonds. They're either going with the Government of Canada bonds, or they have their internal sources of money. And the same idea applies. They basically add a premium, but that premium sometimes is higher than what I just mentioned on insured money. So that's really the concept. This is the source of money. They add a premium to it. As a client, that's what you pay for. That's your rate. In the residential world, it's a little different. Residential world, fixed rate mortgages are based on the bond market's pricing. Variable rate mortgages are based on the Bank of Canada's overnight rates.
Right.
So, and when you get the rate at the time of approval, that is the rate. Where in commercial, you cannot lock it in when you get a letter of interest or even a commitment letter. It's sometimes within a very short window of closing. And if the bonds go up, like you said, that will impact the loan amount. And if you want to keep the loan amount, you may have to buy down the rate to bring it down to a level to give you the original loan amount you applied for. And if the rate goes down, you would benefit.
Yeah. And then it all gets, adding just a lot more complexity to it as you get then a CMHC certificate of insurance that says, well, here's your ceiling rate and here's your maximum loan amount and all that kind of stuff. And then it's just like, well, can somebody just tell me what our interest rate will be? And the answer is no, we can't. Like I keep asking and I keep wanting to know. It's hard. It makes it difficult to do pro forma cash flow. So you have to almost add factors in, you add allowances in, you analyze at a top end, and then you risk and analyze it backwards.
Yeah, exactly. You have to hedge and make in a commercial world, you have to keep your eye on the bonds and just understand where the market is going. I mean, nobody can predict it, but directionally, you want to know, okay, by the time I close, what's the likelihood that the bonds are going to be up? And when the lenders write the deals, they plan for these things in the process as well. It's not like they wake up overnight and go, oh my God, no, at the time of writing the deal, they know by the time that deal is going to close, directionally, where the curve is going, and they hedge for that. But sometimes crazy things happen in the bond market, and like the market panics and something pushes up the rates beyond anyone's expectations, and clients have to buy down the rates. But yes, buffers are everything.
You mean you're bursting my bubble a little bit of having all these people sitting around smoking cigars and throwing darts at a dartboard to try to determine these numbers. Well, but it truly is, and that's where you need to pay even more attention. Like last week that just came. I know I'm dating this and things like that, but last week some unemployment numbers came out that were softer than normal, and all of a sudden, boom, the bond rate dropped, and it's been dropping. It dropped for about 5 days in a row, and then all of a sudden, everybody's going, well, factor in probably fixed rates are going to come down, 20 to 40 basis points over the next little while, and everybody who's sitting there with these CMHC certificates are going, go down lower, go down lower.
I know that's a good one for those who are, about to close, right?
Yeah. But here's just a real life scenario. We had multiple applications that went in that got approved over a course of months. We started at one time with our ceiling rate at 4.25, and then towards 4 months later, the ceiling rate was 4.6. Right. And we're just going like, holy macaroni. Like it can vary quite quickly. So,
yeah.
Now there's an awful lot that we can cover here going on a way forward. So really the bottom line for everybody here is, there are options. There truly are. If you're in the game and you're committed to long-term real estate success, even though the options aren't as good as they once were maybe a year ago, 2 years ago, 3 years ago, there's always an option. And there's always an option to be shared with by a professional on your side. Something might not be working like it used to, but you know what? There's another option, and you adapt, and you either adapt or die. And that's conversations I'm having with lots of people is how bad do you really want it? Do you really want this success? Do you, or were you just, are you an investor of convenience when it was really simple and you were sailing in the hot, in the warm, sunny weather and calm oceans? Or are you, do you want this really badly more than you can almost breathe? So the question I want to ask for you is when you're having conversations with people and people are, you know, they're second guessing and they're having that puppy dog breath and they're panicking a little bit. How do you help somebody get through a lot of that?
So definitely there is pressure, right? And we're seeing it across the board. And I always tell people, like you said, Russell, there is always a solution. So let's sit down and figure out how we can reduce pressure, right? So that could be restructuring debts, that could be deleveraging, that could be creative ideas like what you've shared at the cash flow recharge, bring in an equity partner to help you cover a shortfall or get a piece of the property to offset some of the losses you're temporarily having, but in the long run, everybody wins, or convert it. Let's look at commercial money. Let's look at private money, although it's non-conventional thinking to help you ride the wave. So there is a big toolbox. The question is, and we're going to present you with the possibilities and we're going to guide you through. But at the end of the day, you have to make a decision to actually action it. As painful as it may be, you will have, the choice is yours. Is it easy to go and find equity money? No, it's not. Or yes, it is, because people are sitting on a lot of money. It all depends on how you look at the situation. Some people right now are seeing opportunity. Some people are seeing skies falling and we're all going to die. So we'll help you open up your eyes on what the options are. We'll guide you. But at the end of the day, the choice is yours. And you either choose to tackle the problem heads on, regardless of how simple or how complicated the path may be, and choose to think about opportunities. Because sometimes, you know, there may be a problem here, but you can fix it by identifying an opportunity and not necessarily just like looking through this lens here. So are we helping clients? Are clients still buying? Are clients riding the wave? Absolutely. Is it simple? Yes. Is it easy? Not always. But if you want it, you will do it.
Yep. Well, there's definitely a wave, and either you can be on the bottom and have the wave crash over top of you, or you can get the surfboard out, point it the right direction, and ride that sucker into the shore, right?
Yeah.
So Dalia, man, you're just like, I've been remiss here. You're bringing the fire here. It's like, I'm sitting there and going, and of course, when fire comes, right, the bombs happen. So, where would be the best place for if somebody wanted to reach out to you, get a hold of you? I know you're on my podcast every week and you have your email and stuff like that. But if this is somebody's first time listening, where is the best place for somebody to get a hold of your team and help you have you help them out?
We are all reachable at info@streetwisemortgages.com, or you can go to our website, streetwisemortgages.com, and contact us through the contact form. And then if you want to keep up to date with our content and education, I am mostly active on Instagram at streetwise_investor.
Nice. I think one of the last times we chatted, you were bringing out a fund recent or upcoming, or is that still on the go, or what's happening with that?
It's in the works right now.
Yep.
Yeah. It's
soon.
in the works.
Soon.
Yes. Haven't formally launched yet.
Well, it's funny, like the ideas are the quick things to happen. It's just like, the execution, and once it gets into the lawyer's hands, it's like, holy moly.
Yeah. That's where it stops.
Yeah. Well, let's put it this way. They ask all the nuanced, detailed questions of things that you didn't think about and go, well, is that important? Yes, it is. Okay, well, let's answer all these questions, right?
Yeah. As entrepreneurs, sometimes we're like, I've got this idea. I just want to go. Okay. But I want to make sure I get legal advice.
Yeah.
And then it's like, pause now. Oh, there are all these things that I haven't thought about. Okay, go back and make sure these are covered before we move forward. So that's always the case. But you got to do it because that's how you launch off a stronger foundation, right?
Yeah. And I'm very guilty within our team all the time as I have such an idea and I'm just going and I think it really loud and I make the assumption that everybody can hear my thinking, but sometimes that don't work. So. All right. Well, why don't we leave it there? Do you have any final last words for anybody if what's going on out if they're feeling stuck or something like that, or if you want, I'll leave the last word for you, and if not, that's okay. We can sign off and finish our glass of tequila, if you will.
Let's finish the glass of tequila. No, nice. I'm just kidding. Let me leave that something. Folks, always get a second opinion, right? If someone says you don't qualify or this cannot be done, get a second opinion. Very important all the time. Secondly, on the rates front, I follow some premier rate analysts, and today there was an analysis that went out. I have a copy of it that shows whether or not fixed rates are winning over variable rates given where the market sees the rate direction in the next 12 months. And right now, for the first time, variable rates are making sense compared to the 1 or 2 year fixed rates. Talk about it a month ago before the Bank of Canada announcement came out and before the bond market change. It was 1 year is the way to go and 2 year is, you're taking a bet, but now variable rate have stronger advantage because the differential is very, very small. And we know that the rates are going to slide sometime in 2024. So if you're looking to make a rate decision, consider a variable rate. However, everyone's situation is different. It's important to sleep at night and not go with a one-size-fits-all approach. And we're happy to help you make these decisions if your renewal is coming up or if you're looking to purchase as well. We're here to help.
Yeah, and that's advice I gave to somebody too. Is you rode it up, and variable will be the leading edge of the riding of the down too. So, and it's good to know that what you just said is potentially it now looks like it's at that tipping point. Potentially,
yeah.
Yeah. All right. Before we do send off here, I do want to offer you something here, Dalia, and I want to just offer you something of the heavy lifting that you put into this community. You put in a lot of heavy lifting for real estate investors. You're an incredible advocate and an incredible guide and resource. And some days I would imagine it feels like at the end of the day, it's like, holy moly, I've been talking all day long and I've just been doing one podcast after another and another video and another video and another video. Some days it's one of those ones is it sometimes doesn't feel like it's making a difference. But I'm here to tell you from somebody from an entire opposite end of the country, the work you're doing makes a huge difference. So I'm encouraging you to keep going. Just whatever you're doing, just keep doing it. Okay. Because we need more Dalias in this industry and we need those broad shoulders that you have. We're not talking the 90s shoulder pads or anything like that, but you have broad shoulders and you're carrying a big load and it's not going unnoticed. And I just want to thank you for that.
Thank you very much. I appreciate these words.
Yeah.
You're making me emotional here.
Okay. Well, that's what tequila does.
Thank you. Yes. Thank you, Russell. I appreciate your words.
Yes. Well, thanks everybody. Have a wonderful day. Make sure you share the show. If you have any questions, please let us know. Okay. Bye for now, everybody.
Thank you. Bye, guys.
You're obviously somebody who takes action if you made it right to the end of this video. So you should be rewarded with a couple extra bonuses and goodies. Number one, make sure you subscribe. There will be a button below here to subscribe so you don't miss an upcoming video. And over here, to continue your journey going forward, there'll be a hand-selected playlist and a hand-selected video, just perfect for what you're looking for. All right, gang, continue the momentum. Let's go.